The more months of data you get, like the last 7 months of last year, for sure that's what the path to 2% looks like. And that's the golden path, as I called it, that inflation has come down very rapidly in historic terms without a recession. And that's never really happened before in the US or in almost any of the advanced economies. So let's stick with the program.
Chicago Fed President Austan Goolsbee declining to say when he expects rate cuts in an interview with Yahoo Finance's Jennifer Schonberger. But he did note that keeping policy restrictive could be a risk to inflation's golden path, in his words. He's the latest in a string of Fed officials suggesting we are closer to a cut ahead of the FOMC's July meeting. Joining us now is Thomas Hoenig, former Kansas City Fed president and distinguished senior fellow with the Mercatus Center. Thank you so much for being here. What do you make of this sort of what now seems to be a drumbeat to a cut, likely in September? At least that's what the market's pricing in.
I've heard the drumbeat before. Late last fall, there was improvement in the inflation numbers. We're all ready to cut. They announced basically they were going to do 3 cuts, and then suddenly inflation picked up, the economy remained strong, and they had to postpone it. And it was, I think, unfortunate because they actually led the economy in terms of their announcements to ease financial conditions, and it had its other effects, raising inflation back. So I think they're perhaps, again, very anxious to cut rates. I understand that. But if you think about it, the Atlanta Fed just revised its GDP numbers, raising them for second quarter to 2.5%. The labor market is still strong, even though they say it's weakening. It's actually becoming more in equilibrium. We're still adding over 200,000 jobs. The average is still fairly high. And most importantly, while they keep saying inflation is coming down, it has for the last 2 to 3 months. But actually, inflation for the last almost year has run just about on the CPI around 3% consistently, and on the PCE still 2.5 to 2.6%. They're not at 2%. So I think they should be careful, and I think that's why they're not saying when, because they don't want to suggest something that might not happen, but they are leading the market by keep saying we're going to cut. And I think they should be more cautious in their excitement about cutting rates.
You know, Thomas, you mentioned the labor market there. When we have economists on the show, Thomas, who argue they should be cutting, they often do come back that labor backdrop, Thomas, and in part, you know, they're certainly very focused on the unemployment rate rising, but you don't sound concerned about the labor market.
Well, of course, like everyone else, I watch the labor market, but the unemployment rate is still 4.1%, in some sense, very historically low. I think that part of it is very positive. I like it. But the fact of the matter is, inflation's still 3% year over year, 2.6% using their so-called favored measure, which is still not 2%. And they're talking about rate cuts in September. I think that is kind of a getting ahead of the game, if you will, in terms of cuts. I think the labor market is stable. I think labor wages are increasing. That's a good thing. Retail sales were very strong. Those are all very positive things, and they don't suggest that we need to cut. The other thing I keep reminding them is I've seen this before. In the 70s, they bring inflation down a while, and then they quickly cut, and then inflation would reignite. I know they're worried about leaving rates at 5.25 for too long. I understand that, but when you think about those rates, inflation is 3% using the CPI, close to 3% using their other measures, but the rate is 5.25. So real rates are around 2%. That's not exceptionally high in the terms of the long-term run of real policy rates that give you, I think, a stable economy for the long term. And in that environment, it's going to take a while to get their inflation numbers year over year down to 3%. So why not be patient, watch it carefully, When the year-over-year numbers are clearly coming down and staying down, then they can cut rates. But I don't think they have to anticipate it, and they keep promising the market. That's having its own effects. I mean, right now the bet is pretty safe. If you invest right now and the only way interest rates are going is down, you have a pretty safe bet. And I think that has its own effects that the Fed should be aware of and taking into account.
We have talked to a lot of folks who say the balance of risks are in waiting too long, not in cutting too soon. I mean, if you talk to folks like Mohammed El-Arian, they talk about that the economic risks, the risks of to the labor market, for example, that those risks are mounting. It sounds like you don't see evidence of that, of the sort of recession risks climbing here.
Well, I can't predict recessions, and it's hard to know, and I understand their dilemma. I was there as to whether they are leaving rates too high too long. But I think if you look at real rates, they're not exceptionally high. 2% is not a particularly high level, number one. Number two, if they ease too soon, they will, I think, risk reigniting inflation, and that is the heavier tax. I think they have room to wait, and why not be cautious? I don't mean to say, I'm not saying raising rates, but they should be very cautious in terms of how quickly they cut, given the strength of the economy. 2.5% growth, a good labor market overall, good retail sales overall. These are all positive things. A very strong stock market, despite some volatility, very strong stock market. Real wages are increasing. So I want to do the right thing, but I want to do it prudently, and I want to make sure the Fed doesn't have to reverse itself again. And that would be, you talk about a loss of credibility. If they eased and inflation took off, I think they would lose a tremendous amount of credibility in the public and among politicians.
Thomas, quick question here. You saw former President Trump gave an interview to Bloomberg Business Week, Thomas, and he said the Fed should abstain from cutting rates before the November election. It's something that they know they shouldn't be doing, Trump says. I'm just curious, Thomas, how does the election, if at all, impact if and when the Fed cuts?
I think the Open Market Committee will be trying not to be swayed by political events. They're very careful about that. Now, you can't talk about it over and over again and not hear it. So they have to take that into account. But I think they will do, when it really comes down to it, what they think they should. And I'm hoping, not because Trump is speaking or Biden is speaking or any congressman is speaking, but because they know it's prudent to wait, that they wait beyond September, depending on, of course, if they get a shock, the banking industry gets under significant pressure, they will and should ease rates, at least for a while, to get through the shock, just like they did in March of 2023, but not for political reasons.
Thomas, thank you so much for joining the show today. We appreciate it.
We're glad to be with you, and thanks for having me.